AI-led equities, a more opaque Federal Reserve, and a sliding yen are pulling asset prices in different directions, even as oil trades back near pre-war levels. Welcome to vTalkInsight, Allocator's Lens Daily for July 7th, 2026. Let's start with equities, where the tension between exuberant earnings expectations and tightening financial conditions is coming into sharper focus. In equities, the core story is that AI and semiconductors are still doing the heavy lifting, but the rally is slowly broadening and expectations are getting very demanding. The S&P 500 is up around 25% so far this year, with the NASDAQ and chipmakers out in front. And yesterday the index added just under 0.75% as the semiconductor index jumped again. Under the surface, earnings are doing a lot of the work. Recent seasons saw 7 of 11 S&P sectors post double-digit profit growth, and upgrades are now coming not just from U.S. tech, but also from Europe and Japan. Looking into the current quarter, many expect another double-digit earnings gain, led by AI beneficiaries, but increasingly supported by sectors like healthcare, industrials, banks, and energy, which fits with the soft landing narrative we have been discussing in recent days. The semiconductor complex is at the center of this optimism. Samsung is expected to post a dramatic rebound in profits, while SK Hynix is lining up a very large U.S. listing with strong early interest, and memory makers are shifting toward multi-year contracts that lock in pricing and margins. There are even estimates of a $100 billion order backlog and a supply-demand imbalance in AI memory that could last into 2028, which, if realized, would underpin earnings visibility across the group. At the same time, several signals point to froth. Some of the recent surge in chip and AI names is being linked to technical flows and short gamma positioning rather than fundamentals, and there are warnings that semiconductors could see a correction of up to 30% as momentum cools. Leadership is still narrow and valuations elevated, and the move by central banks away from quantitative easing toward balance sheet reduction makes sustained price to earnings multiple expansion harder to justify at the index level. That tension is driving a quiet rotation. Small caps and equal-weighted indices have begun to outperform. Capital is shifting from overextended chip names toward hyperscalers and more cyclical sectors, and there are signs of renewed interest in lagging regions, such as Europe, where limited AI exposure has been a headwind. Recent M&A, IPO activity, and events like SpaceX entering major indices also fit a late cycle. Risk on tape, suggesting there may still be room for catch-up outside the mega-cap complex if earnings remain supportive. For allocators, that leaves a constructive but fragile backdrop. Some valuation and sentiment models support index targets above 8,000 over 12 months. Yet near-term earnings expectations are now high enough that any miss, especially in AI leaders, could trigger outsized moves. With equity volatility gauges back in the mid-teens, even as the Fed signals less forward guidance and more data dependence, the coming earnings season and Federal Open Market Committee communication could both be catalysts for a reset in leadership, rather than necessarily in overall index levels. Turning to rates, the key shift is not a single move in yields, but growing uncertainty about the Federal Reserve's reaction function. Policymakers are stepping away from explicit forward guidance toward a more data-dependent stance, and upcoming minutes are expected to show how many officials still want to tighten policy further. Some see the emergence of a more credible and less interventionist Fed that keeps short-term policy rates above 4% and potentially pulls the whole curve higher through 2027 as balance sheet runoff continues. Yet, elevated real yields and treasuries are already attracting substantial demand, and there are signs that lower back-end yields, helped by debt management and policy coordination, are anchoring the curve and indirectly supporting equities. Against that, upward pressure on the long end from heavy U.S. issuance and rising Japanese yields is making price discovery harder for duration, especially in long-dated corporate deals from capital-intensive tech and infrastructure names. Even so, despite about a 45 basis point rise in the 10-year yield this year, total returns are slightly positive, underlining how higher starting coupons have shifted the rates conversation toward collecting income and away from pure recession hedging. In credit, the message is that markets remain very open and investors are still willing to fund risk at tight spreads. Investment grade and high-yield issuance, including from AI-related borrowers, is being absorbed smoothly, supported by solid corporate fundamentals and attractive all-in yields that compare favorably with recent history. Rather than using credit purely as a hedge, many portfolios are focusing on carry in what is seen as a range-bound yield environment. Opportunities are noted in extended investment-grade segments, such as utility hybrids, lower-tier bank capital, and select data center financings, where structural features push yields roughly 1 percentage point above mainstream indices without necessarily implying weaker underlying credit quality. The main risk to that benign picture is a renewed backup in Treasury yields as the Fed minutes, data, and supply interact, which could widen spreads tactically even if fundamentals stay sound. Some of the more interesting value is described in emerging market local curves, such as Mexico, where 10-year bonds yield around 9% and forward inflation expectations are drifting lower, offering a different way to access income if disinflation continues. Foreign exchange is where policy divergence is most visible, and the Japanese yen sits at the center of that story. The currency has weakened beyond 162 per dollar. Hedge fund short positions are the largest since 2017, and there is active debate about whether authorities will tolerate projections toward 165 or step up intervention. What makes this more complex is that Japanese 10-year yields are now at their highest since the mid-1990s, yet the yen keeps sliding, highlighting how wide the gap remains between domestic policy and the Fed's higher for longer stance. Some officials argue the yen is as much as 20% undervalued, with fair value closer to 130. So any shift in policy or tone could force a sharp adjustment in what has become a crowded funding trade. The yen is not alone. Low-yielding currencies from the euro to the Swedish krona and several emerging markets have lagged as investors finance carry into higher-yielding assets. The South Korean won, in particular, is flagged as significantly undervalued even after recent weakness, and upcoming capital flows linked to large tech listings, alongside reforms like 24-hour trading, could provide a test of whether those valuation gaps start to close. Finally, in commodities, oil is quietly reinforcing a disinflationary backdrop while keeping a geopolitical risk premium in the background. Brent has slipped back to around $70 to $72 a barrel, close to pre-war levels, and OPEC Plus is moving ahead with modest quota increases of around 180,000 barrels per day into what many see as an already well-supplied market. Saudi Arabia's largest price cut to Asia in more than 2 decades, together with forecasts from some banks for prices closer to $60 by year-end, underline concerns about oversupply and patchy demand, particularly in parts of emerging Asia. That said, there are indications that prices may have found a floor near 70, with further decline seen as unlikely unless growth slows materially or new supply comes on unexpectedly quickly. Geopolitics means the downside is not one way. Tanker traffic through the Strait of Hormuz remains well below historical norms. Attacks and tighter protocols in regional waterways persist, and insurers are pricing in structurally higher shipping costs, even as cargo flows gradually normalize. For multi-asset portfolios, cheaper crude currently supports the soft landing and lower inflation narrative that helps both rates and equities, but the concentration of global supply in a few choke points keeps the risk of a sudden, volatility-inducing spike firmly on the radar. Stepping back, the cross-asset picture is one of tentative balance between powerful micro-stories and more challenging macro signals. Equities are being pulled higher by AI and broadening earnings, yet valuations in parts of tech look stretched and increasingly sensitive to both company guidance and higher real yields. Rates sit in a narrow corridor between a more opaque, potentially higher for longer Fed and strong demand for income, while credit markets continue to fund the CAPEX cycle at tight spreads as investors emphasize carry. In currencies, extreme yen weakness and undervalued Asian FX highlight how far policy divergence has run, and oil trading near pre-war levels adds a disinflationary cushion even as shipping routes remain vulnerable. Over the coming weeks, the key variables to watch across assets will be the tone of Fed minutes, the earnings messages from semiconductor leaders and hyperscalers, any sign of official pushback against crowded yen shorts, and whether crude can hold its current range. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.